Can you see my screen?
Yep, you're all good.
Sounds like a plan. Everyone who's on here has seen this flyer, first time home buyers and the power of credit. So thank you for being a part of this. All right. I'll start off with a question. Who wants to buy a house in 2020, but their credit may be holding them back? Who wants to buy a house in 2021, but their
Mhm.
credit might be holding them back? Who has plans within the next 2 to 5 years to uh, become a homeowner? But there's one little thing that's holding you back, and that might be your credit. All right. So we're going to talk about the power of credit. Credit is generally defined as the contractual agreement in which a borrower receives something of value now and agrees to repay the lender at a later date. And that's generally with interest. And that's usually how credit works, right? We're all familiar with that. Right. We're going to talk about the power of thought. So let's look at some statistics. Did you know that 77% of Americans have bad credit at least once in their lifetime? Did you know what is considered bad credit? Anything that's lower than a 700 score. All right. One third of Americans have a credit score under 600, under that 600 score. And 68 million Americans currently have bad credit. All right. Some more statistics. Credit card debt in America is a whopping $911 billion. So if we look at that on average, we're looking at $15,000 per household has credit card debt. Mortgage debt is a $8.9 trillion, and this is recurring every year. So on average, we're looking about an average household of having $180,000 of mortgage debt. Then we have auto loans. Auto loans contribute to the debt population of $1.23 trillion. So, on average, the average American household has about $27,000 in automobile loans. And these types of loans that we're talking about are installment loans, fixed loans that you're paying down on, but the average is about 27K. Now let's talk about the student loans. Everyone has student loans if you've gone to college, and unfortunately, we're looking at $1.4 trillion. And I say little victims because they're just children entering the real world, and they're coming out with this financial bondage. I just want you to think about that. And how do we get here? Well, we got here because of lack of understanding or ignorance, right? And I'm using the word ignorance because of the fact that it's one of those words that when you hear, you think of it in a negative connotation, but it really isn't. Ignorance is simply defined as the lack of knowledge or information. So, because we didn't have the lack of knowledge and information, our financial literacy level wasn't up to par. Unfortunately, financial literacy is not taught in the United States. No one is educating consumers, especially our children, the proper way to use credit cards responsibly. All right. Another thing is the power of mindset. We're too accepting. We're too accepting of debt. There's no debt management. We tolerate debt, right? Debt becomes a household name for most. It's one of those things that we're just living with. And I remember when I was in college back in 1996. I'm dating myself, but my favorite place to go was Denny's. And that was because pizza and ramen noodles, it just had to go. I mean, how much pizza and ramen noodles, could someone get? And the reason why I upgraded was because I got a credit card. And that credit card upgrade was not only for me, it was for me and my crew. Me and my people, we were at Denny's, and that's what we did. And we were living large. But guess what? I had no job, but I had a credit card. And no one taught me how to use that credit card. Right? We allow this debt to fester. We allow it to accumulate, and it grows. And guess what? Instead of paying it off, remember I said credit isn't a contractual agreement. Instead of paying it off, we choose to wait for that statute of limitation, which is typically 7 years, right? And the idea here is that we can just wait for it to fall off. but we're not understanding all of the damage that it's doing when we do that. No one's teaching us how to save. No one's teaching us the power to save. And then maybe they are, but you know what? No one's giving us the discipline to set it and forget it. How many times have we started a savings account and we broke that piggy bank and we took the money out of it, right? Now, only a few people know the secret to financial freedom. And this is what this class is about. We're going to learn the secret to that. We're going to learn the secret to breaking that financial bondage. All right. One portion of it is that knowledge is power. Okay. But without knowledge, action is useless. I apologize. I even say this. I'll rephrase that. Without we have the knowledge, but without action, without putting it and applying that knowledge, it's useless, right? And that's what we're going to talk about in this workshop. We're going to gain the knowledge. We're going to apply the knowledge. We're going to move from informed consumers to game changers, all right? So in this workshop, Miranda's unqualified potentials are going to turn into qualified buyers, right? We're in this workshop, we're going to turn those with bad and less than perfect credit victims to members of the 700 Club, right? Today, Miranda's existing renters today are going to be the homeowners, right, of tomorrow. And in this workshop, we're going to make sure that those existing homeowners, right, are able to improve their credit status so they can now refinance for lower APRs and lower interest rates. All right. We want to make sure that you are credit worthy customers. All right. This, unfortunately, is not a credit worthy customer. And a lot of people, I can't even say that they settle for a score of 520. Most Americans don't even know what their score is. All right. Again, we want to make sure that you are credit worthy. Your credit terms are give you the loan amount and the interest rates that you'll be receiving. So you have a lower loan amount and a high interest rate if your credit score is low. But what we want to do is we want to make sure you have a high loan amount and a low credit interest rate. All right. That boils down to credit worthiness. I think we talked about it earlier, that credit is everything. So how many of you know that good credit makes it easier to get new houses, right? Good credit makes it easier to get new cars, a lower interest rate on credit cards and loans, higher limits, contracts without security departments. And that's what we're going to be talking about today, right? So we want to make sure that you're credit worthy consumers. It's all about the power of choice. And one of the choices we're going to do is we're going to choose to start looking at our credit score to figure out where we range and where the work needs to be placed. A credit score, if you notice on this chart, of 520 or lower is literally the worst credit that you can have. It states that you're facing extreme credit issues. The likelihood of you being approved for anything is null. Then you have 520 to 579. That's very poor. You have several credit issues, and you're unlikely to qualify for any loan. All right. Now, some people say, well, I have about a 600. Even in a 600, you're still below average. You may qualify for most loans, but you significantly higher interest rates. And that's what we're going to talk about. That's the mindset that I want you to have. Okay, I might have a credit score, but you know what? What's my interest rate? What interest is this affording me? Right? We want to make sure you're in the green. We want to make sure that you're in the 740 to the 779, the 780 to 850. I call it the 750 club, right? The 700 club, but we're shooting for a 750. All right. Usually with that you have very good credit, you usually qualify for the best interest rates. All right. And the 780 and the 850 qualify for best interest rates automatically. All right. So that's what we're shooting for. All right. We're going to talk about that. The power of credit. How important is your credit? Here we have some vehicles that we're trying to purchase. We're going to try to purchase it with good credit, and we're going to try to purchase it with bad credit. Right? A $20,000 auto loan or installment loan for 5 years, that's 60 months. If you have good credit, now good credit, we're talking about, say, that 740 range. You're looking at an interest rate about 6%, an average monthly cost of about 387, right? Well, bad credit anywhere low 600s, 500s, If you got an interest rate of 26%, you're actually looking at a 500 or lower. And I'm not really certain why you would be looking for a vehicle, because my thing is you have an interest rate of 26%. And how does this pan out? You're paying a monthly a payment of $599. You might get the car, which is you think is great. You're paying double the amount for the vehicle to begin with. The total interest on $20,000 at 6% is only $31.99. It's about $3,200 on top of that. So the total cost of the vehicle, you're looking at 23.2 or 23.2, right? 23,200.
Mhm.
Unfortunately, the interest rate on bad credit, you're looking at $15,000 of interest.
Mhm.
That's 15,000 on top of the 20,000. That 15,000 is not is that could be two cars, that could be another car. You're paying another vehicle because of that. That's a difference. But good credit and bad credit is a difference of $12,730. And I just want you to just really think about that. Same thing. We have another vehicle, $25,000. All right. Good credit, bad credit. 5 years. You got a 2.99 interest rate. You probably got that high 700s going into the 800. And then you might be doing a little better. You might be in the 600s, high fives at an 18%. But again, look at the difference. You're paying 448 versus 635, right? Payment difference of $187 and an interest rate difference of $11,220. So you cannot afford not to fix your credit, or at least to look at it to figure out what your interest rates are. All right. How important is your credit score? What do all these houses have in common? These houses all range within that 100 to $200,000 range. Let's look at how your credit affects you purchasing a home. So you have a $200,000 home at a $30,000 fixed year fixed. And Miranda can go a little bit more about these numbers, but I just want to give it to you just so you can kind of see it. So you have a credit score of about 560. I'm not certain if you can get away with a 550 in order to purchase a home. I would shy against it. The only reason is because the name of the game is to save. The name of the game is to save as much money as you can and to make sure that there's more money in your pocket than in the government and in the banks. And if you go into purchasing a home at a 560, you're giving money away. And if you look at it here, you got a 560 versus someone with a credit score of 740. The same home, the same neighborhood, nothing's different, the same city. You're looking at paying a mortgage payment of $958 at 740 credit score versus $2,210 per month with a 560 credit score. And the difference is just fixing it up. It's just waiting up a little bit longer, investing in yourself to make sure that those payments are being made on, for your credit, for your history, so that you can boost that number. All right. So you're looking at 12.988%. That's 13% on a $200,000 home versus 4% on the same home at $200,000. Look at the difference of what you're paying after that 30 years. If you wait the whole 30 years to make sure that you've fully matured and make those payments on that home, you're looking at $795,620. Wow. That's about $5,000 or $6,000 more than what you purchased the home for, versus the total of $344,178. Now, the game of the game in real estate is you have to, they're gonna make money off of you anyway. You're gonna pay some sort of an interest rate, but why would you want to pay that much more money to this home? That 795,000. That's what? How many homes? That's what, 4 homes that you could have purchased, or at least 3 homes that you could have purchased if you had and invested in if you had a higher credit score. So I just want you to really look at that. Right. So let's talk about what affects your credit score. It's a 4-letter word called FICO. All right. And FICO stands for the Fair Isaac Corporation. So originally, it's a data analytic company based in San Jose, California, and it focuses on credit scoring services. So they look at your revolving credit, They look at your installment credit. And these lenders use borrowers' FICO scores along with other data of the borrower's credit report to assess credit risk and determine whether to offer or to extend your credit. All right. So everything that you do revolves around credit. Everything that you do with your money is being recorded. All right. So let's talk about how it's calculated. So your FICO score, and this is I want you to really listen to this. So your FICO score, there's 5 factors that affect your FICO score. All right. The largest that I really want you to pay attention to is your payment history, and your payment history has to do with how are you making these payments? Are you making the payments on time? If you're late on your payments, that's costing you 35% of your score. All right. 35% of your score has to do with how you're making these payments. 30% of your score is the amount owed and also the credit utilized. So my thing is this, you think you have a $5,000 credit score, right? And you think that that's your limit. I'm not certain if you know, but you really should not go more than 30% of whatever that limit is. So someone with a $5,000 credit score really has about $1,500 that they are able to spend within that month without it affecting 30% of your credit. So let's make that into layman's terms. Someone that has maybe $1,000 credit limit, right? And if you're only using 30%, that $1,000 credit card really gives you $300 of buying power.
Right.
And you want to make sure that within that, by the end of that month, that you're under 30% of that credit score. So you have $1,000 credit card. You want to make sure that you're not spending $700 and leaving that over for the next month, because that's 30% of your score reducing. All right. We want to make sure that if you have $1,000 credit card, that you use 300 of it, but make sure, hopefully you're paying it off, but make sure it's under that 30% threshold. I would say about 25%. Make sure that you're using, and if you're going to carry over any debt from one month to the next, it has to be under that 30%. 15%. How long have you had your credit history, the length of time? Have you had it for 1 month? Have you had it for 10 years? And then if you've had it for longevity, again, what's your payment history and what's your credit utilization? All right. Another 10% has to do with types of credit. I talked about installment credit. So you want to have a mix of credit. You want to have your revolving credit and your installment credit. Your installment credit, we suggested, has to do with your car loans, your mortgage payments, any payment or fixed payment that you paid down. That's installment credit. Your revolving credit is typically any credit that automatically renews as your debt is paid off. So, such as your credit card, you want to make sure, again, that it's under 30% uh, utilization, and that you're not carrying over more than that over to the next month. All right. And then the last 10% of your credit has to do with new credit. So once your credit score boosts and it improves, and you start getting approved for new credit, that's 10% of your credit score. Now, if you apply for a credit card
Yeah.
and unfortunately you don't get approved for
Yeah.
that credit card, again, it works in the reverse. It'll be 10% of your credit score being reduced. So you want to be wise when you're purchasing new credit, all right, or applying for new credit. All right. Other factors that affect credit. All right. Inquiries. Soft inquiries do not impact, or they're not reported by the credit bureaus. They're not reported by Equifax,
Mhm.
Experian, or TransUnion. All right. Hard inquiries. Basically, stay on your credit for 2 years. You want to make sure that you're not having more than 2 or 3 inquiries per month. Looks very bad on your credit. All right. And again, when those hard inquiries are reported, it stays on there for 2 years. You have your delinquent payments, making sure that you do pay your bill. Again, it's a contractual agreement, but if you don't pay it, guess what? 7 years. All right, defaulted accounts. Well, I'm not going to pay this. I'm going to wait it out. Guess what? 7 years, and it brings on this thing called charge off. And you think a charge off is great because it falls off. It doesn't. All a charge off means is that it gives a green light for another company to buy your credit, buy that credit for you or buy that loan, contact you, and start the process all over again.
Wow.
Foreclosure, 7 years. Someone, unfortunately, anything can happen, especially in today's society. You're unable to make the payment on the home, and it get foreclosed. You enter into foreclosure. And if I'm not mistaken, I think foreclosure starts when we don't pay your mortgage after the first month and after that grace period. So it's pretty quick before for foreclosure. And
I think
again,
it's
that's
about 60 days. Yeah.
60 days. Absolutely.
Yeah.
Look at that. So that's 7 years that foreclosure affects you. All right. And then we have a bankruptcy discharge. I implore you all, please do not go into bankruptcy. There's other avenues and other things that you can do before you think about bankruptcy. All right. Bankruptcy, depending on what it is, anywhere between 7 to 10 years. All right. You're going to be looking like this emoticon, if you continue with that type of behavior. All right. Other factors. Now, homeowners also affect, your behavior also affects the type of credit that you have. So a lot of homeowners kind of think that, what, I'm in a home, I'm fine, I don't have to worry about it. But you still have to look at your credit, because you can start off with maybe a 750, close to an 800, and because of your decisions, your credit, starts to, suffer, and it gets lower. Your credit score loss on, we're going to be looking at the credit score loss on selected derogatory marks. All right. So if you're 30 days late on your mortgage, that's 70 points from someone that has a 680 score. It's 80 points from somebody that has 720. So the higher your credit score, the greater impact it has on your credit score if you're late. 90 days late, and you're working something out with the mortgage company, again, the numbers go up. If you have a short sale, you're not able to make those payments, and you just, I got to get out, or you're trying to get out the home quick, anything can happen. That short sale, believe it or not, goes against you. You might think, oh, I sold it. You're not getting any equity out of the house, you're out of the obligation, but that short sale just cost you your credit. Same thing with the foreclosure and bankruptcies. As you can see, the numbers and how it affects your credit goes higher. So you can end up in a 600 credit score, and starting this whole process all over again if you go bankrupt. All right. But you know what? How do we fix this? You guys have rights, and we're gonna talk about it. It's another four-letter word, the FCRA, the Fair Credit Reporting Act. All right, the Fair Credit Reporting Act was passed by Congress in 1971. It basically promotes the accuracy, fairness, and privacy of information in the files of consumers reporting agencies. And basically, what that means is that gives you the right to access your credit, to correct any inaccuracies in your credit report, and the right to seek any damages against those who violate that law. So, any derogatory marks, any late payments, anything that's on your credit score that shouldn't be there, your name might be wrong. You have the right to dispute these things. And this is what that law in 1971 that was passed, the Fair Credit Reporting Act, gives you the right to do. All right. So look, our company, the M&L agency, is one of those companies that are able to help you to clean up your past, so to speak, to clean up your act, to clean up, how you're maintaining, your credit. And I wanted to show you a lot of us, those who know me or know the company. This was our logo. Recently, we just updated it, so we have a new logo. So if you see this, it's one and the same. And you can reach out to us at themnlagency.com. And basically, what we do is we just help individuals and families to understand the importance of financial literacy. We ensure that families are fully covered and able to leave an inheritance for their children's children. And how do we do this? We analyze credit. We ensure you have proper insurance and that proper insurance is being used properly. We educate on the importance of maintaining and building wealth, and we help with retirement planning. Our mission is to change the narrative of financial illiteracy by sharing and exposing the message of financial education. And that's just a plug in that I wanted to give you in regards to what our company can do for you. All right. So basically, how do we do this? Well, we partnered with a company called United Credit Education Services, and they're committed to helping individuals and families build, organize, and protect their financial future. And they do this because they have a flagship product called a credit repair system, right? And then it's also coupled with a financial literacy education program, right? Now that the services that they offer along with the credit repair are budgeting. So they want to make sure that, in order to make sure that your credit gets right and your finances get right and you understand the importance of finances, they make sure that you are budgeting properly. And then after that, they want to make sure that your credit is either built or restored. And then there's a credit builder. So for those that are may not have bad credit, but just want to build on what they currently have, this we provide you information on how credit works, on the things that you can do to establish and build better credit. There's a credit attorney that you have um, at your disposal. You're able to advocate on your behalf any of those hard credit issues, or maybe you have creditors that are harassing you. This is where you can contact somebody physically and they will advocate on your behalf. There's a credit monitoring system called Smart Credit, and it's not just a tool or an app on your phone that you could see what your credit score is. This will customizably show you how to get that score that you're looking for. So it will literally give you a customizable way to shoot for that 750, to shoot for that 800. All right. Another cool thing about that is it doesn't just show two credit bureaus like Credit Karma or Credit Sesame that only shows TransUnion and Experian. It shows all three credit bureaus and it is at your disposal. We have a debt payer for those who are trying to, get out of debt. And this cool thing about it, it's not just a tool, it's a program that actually shows you how to get out of debt without having to pay anything extra. You have a financial lockbox, you have identity monitoring, you have net worth, you have a savings goal, you also have will and trust. And this will and trust is yours. On average, the will and trust and power of eternity can cost you anywhere in excess of $1,500. And you get this with this program, with this bundle. Now, we talked earlier about, having an inheritance for our children's children. Well, this YFL, which is the Youth Financial Literacy Family Mint, actually teaches children from ages 6 to 16 how money works, how finances work. I mean, if we had this education when we were younger, if we understood how money worked, if we understood finances, and we had a program in the school system when we were younger, we definitely, I know I would have made a lot of different choices growing up. Right. So, one second. So, I want to just show you about the flagship product. The flagship product is credit restoration. So, when you're thinking about a home, this is pretty much what you're looking for. You want to make sure that your credit is in the 750s, and if it's not, again, this credit restoration program will definitely get you there. We also have another program that we can get you in for those that are renting, and it's called Credit Meet Rent. It's basically you can use anywhere of 1 to 2 years of your past credit or excuse me, rent or month to month rent, and you can use that as a positive trade line with your credit bureaus. And basically, this is what a lot of the mortgage companies and the brokers are looking for. They want to make sure that one, you're making sure that you are responsible, you can pay that mortgage, but this also helps you to not only build your credit, but now you can use something that you're already doing to do that, and that's basically the Credit My Rent. All right. Really quickly, These are the mistakes I just need you to stop doing. One, please take notes. Stop making late payments. All right. These late payments, again, are 35% of your score. I need you to not stop not using major credit cards. What do I mean? Stop using department store cards and start using major credit cards. The major credit cards, Master, Visa, these types of cards are the cards that you want. I'll give you a little tidbit. The department store credit cards, basically, they win when you use them. Why? Is because more chances than none. It doesn't matter what your credit score looks like. There is going to be a double digit interest rate associated with that card. Yes, you'll be more likely to get approved for it, but it doesn't stop them from charging high interest rates. So that cashmere sweater that you're purchasing, that couch that you're purchasing, guess what? You might as well put two or three at the table and give them cash because of the fact that they're charging you extra interest on top of that. You're always going to be paying more. So again, use major credit cards, and then those department store cards are not likely to be reported with the credit bureaus. All right. Stop maxing out your credit cards. All right. 30% credit card utilization. Find out what your credit card limit is, multiply that by 0.3, all right, or 30%. That's your max. And I would just do it even to make sure. I would do it by 0.25, 0.27. Make sure you're under that credit card utilization when that month ends. All right. Please, you need to start checking your credit score. Stop avoiding what your credit report looks like. All right. And then another thing, co-signing. Hold on for 1 second here. Forgive me. Okay. I thought there were some people joining. All right. So please stop co-signing for anything. Co-signing. There's probably a reason why you would like to co-sign. And after this, if you please feel free to contact us and we can kind of give you a little bit more information in that regard. But co-signing, it doesn't help the person that you are allowing to co-sign or you. I know back in the day, I wanted a vehicle. I really messed my uncle up by having him co-sign for me. It doesn't allow the person who's the cosignee to learn anything about their credit. They're probably going to continue doing the same things, the same bad habits in regards to that cosign. So stop cosigning. Another is stop not disputing inaccurate information. And in order to know that there's inaccurate information on your credit, you got to look at your credit. All right. Another things, falling for anyone with bad credit is approved. Bad credit, no credit, okay. It is not okay. Bad credit, okay. I repeat, it is not okay. Everyone gets approved. Bad credit, no credit, write-offs, slow payments, repossessions, bankruptcies, any of these. If you see any of this, please do not pass go. Reject it. This is going to mess up your credit, number one. And then why? Because it's going to keep you in that same frame of mind. And then number two, you're going to be paying these high interest rates. And again, that's what we're trying to prevent. Now, through myself partnering with the United Credit Education Services, we are able to remove bad credit. We're able to remove collections. We're able to remove those judgments, bankruptcies, anything that's on there that's lingering. We're able to remove those. So you need to work with us, and we'll be able to assist you. And my clients usually, when they come to me, it takes about 45 to about 90 days to see some changes. And, within about 6 months, that they're definitely improvement of credit without a shadow of a doubt. So by all means, please utilize us. All right. Don't forget, you might start late. You might start over. You might have fears. You might be unsure. You might act different or indifferent. You might have tried credit and tried to, boost it up and try to improve it. You may have failed, but I'm telling you, you can still succeed. All right. I'm going to leave this up a little bit longer. We are the M&L agency. We offer credit repair. We're also a life insurance agent, licensed in New York, New Jersey, Florida, and Connecticut, I believe. All right. And then we can also be licensed in any other state that you would need to be, just let us know. We provide mortgage protection coverage. So those that have homes or those that are looking to purchase homes, we want to make sure that you and your family stay in those homes. So if you have, anything happens to you and no longer there, we can work with you so that you have that mortgage is still paid off. We also have final expense. So reach out to us. We're here for you. With that, thank you for hearing me. I'm going to pass it over to Miranda Walker right now.
Hi,
Awesome.
Miranda, before you start, I just
Yes.
wanted to bring to attention that Miss Dorothy, she had a question for you as you were speaking about major credit cards, Lamont. She asked, does this include Amazon?
Right.
Good. Does it include Amazon? Amazon is a department store credit card. Um, no, you know what? I'm gonna say Amazon actually is reported. So Amazon, yeah. So how you pay on that Amazon credit card, and I can tell you that by experience. I had an Amazon card that I applied for, and yes, it does affect your credit score. I put it to you this way: anyone that has a credit card, right? I think you should follow the that FICO rule. The 35%. Make sure you're not making late payments. Those late payments are gonna eat you. The second thing is making sure that you're not paying more or you're not utilizing more than 30% of whatever that limit is. So you're not carrying over excess loans or debt over for the next month that's more than 30%. I would say make sure that treat it like a charge off card where you got to make sure that debt is paid. If you got a $5,000 credit card, really be careful. There's agencies that are out there that says, oh, bad credit, don't worry about it, we can get you funding, we can get you a $10,000 credit card. But guess what? You still can't use more than 30%. And then you have to look at the fact that, okay, I got a $10,000 credit card. What does my income ratio to that credit card look like? Can I afford to spend $10,000? Can I afford to spend $5,000 and pay it off at the end of the month? So think of it that way. Um, Anyone else with any other questions? All right, awesome. So again, I'm gonna pass it over to Miranda, and um, thank you.
Awesome. Thank you, Mr. Ford. So basically, my piece is very small. It's the real estate aspect. And so I'm just gonna give you guys a highlight of like 6 to 7 things that needs to be done before you can even consider potentially purchasing a home, a property, or whatever it is you want to do in relation to real estate. So the first thing is your credit, obviously. Um, Hold on one second. So your credit score is the most important aspect when it comes to real estate. Um, I know some people are able to get mortgages as low as with a credit score as low as 580 to 640, but I wouldn't recommend it based on the interest rate of what you would be paying on the mortgage that you would be obtaining. Number two, please do not start looking for real estate until you have checked your credit score. This is the number that mortgage lenders look at to determine whether you are credit worthy. Okay, the higher the score, the lower the interest rate, as Mr. Ford had already indicated. Okay, um, the next thing is if there are any blemishes on your credit score, you need to fix it. Okay, you need to clean up any blemishes. Let's see. There may be a few surprises on your credit that you may not be aware of. And this is where Mr. Lamont and his agency will come into play. And then once you pull it, you have to review it and work on fixing anything that is out of place. All right. The next thing that you need to do is, let's see, you must determine how much you can afford. So you make sure your lender can help you determine the right amount based on variables such as the size of your down payment, the type of mortgage you will qualify for, and current interest rates. Okay. The next step that you will take is shopping for your mortgage lender. Prospective buyers should make one of their earliest stops with the mortgage originator to see if they qualify for a mortgage and confirm how much of a mortgage they can afford. And please shop around. You don't have to feel pressured to go with the first one that says yes, you qualify this amount. I would say shop around for at least 2 to 3 different lenders or companies, and then you compare, and then you make your decision from that point on. And then the next step is to secure your mortgage pre-approval. A lot of people that I've dealt with in the past, when they've been looking for properties, they may have a down payment amount saved in their bank, but then they don't have a pre-approval. And a pre-approval is basically what the mortgage lender will give you to certify what you qualify for once you want to put in an offer on any type of property that you deem, fits your lifestyle. So without the pre-approval, it's almost pointless to even shop around for real estate, because that piece of paper holds a lot of information and power for the potential seller of the property. And for us as real estate agents, we get to review what's in the pre-approval letter, and then we will shop for properties within that price range that will fit you and your family's needs. Okay, so that's very important. I've dealt with a lot of people who say, I'm ready to buy a house. And then when I say, okay, can you please send me your pre-approval? And they don't have it, or they don't. When I talk to a client and they have a pre-approval, that tells me that they are serious. They are a serious consumer who's ready to buy. But when you come to me and say, I want to buy, let's start looking, and when I ask you for the pre-approval and you don't have it, that's an indicator to me that you're not ready, or your credit is not up to par, which is okay, because a lot of us have fallen on bad times, and we may have some blemishes that we may not want to share with people. But if you're looking to move into that next step in your life, sometimes you have to deal with the things that are the most hardest. Okay, so I tell all my customers and clients, please work on your credit. It's so important. And then the next item is, when you prepare yourself for a home purchase, save up for your down payment. Okay, sometimes people are gifted down payments. Sometimes, like Mr. Ford says, insurance is important, because sometimes 9 times out of 10, if you have responsible family members who think about legacy, they will purchase insurance. And when they pass on, sometimes your family members will leave you an inheritance, which could be in the form of life insurance policy. And most people that I work with, that's what they use as their down payment to purchase their property, which is a beautiful thing. Okay. Next thing up is, once you're ramped up and ready to buy a home, it's wise to not make any major purchases, especially in your finances. Like, don't switch your job. If you've been on your job for 5, 10, 15 years, don't decide once you're ready to buy a house, I want a new job, because that just won't look right. Don't buy a car. Don't buy furniture. Don't apply for new credit. Good. So a lot of the things that Mr. Ford has already indicated, it kind of ties into what I'm saying as well. But his is the most biggest piece, because it actually talks about your credit, how to fix it, how to get it higher, what to remove, how to remove it. And then I'm the last piece. You come to the real estate agent once you've worked on your credit, once you've saved up enough money, you might have been gifted some money. Then I'm the last piece of the puzzle that you come to say, okay, Miss Walker, can you connect me? I want to look for a property for myself and or my family, and I will be happy to help you and walk you through the process. Sometimes I have to be a counselor. Sometimes I have to be a teacher. Sometimes I have to be a parent. Sometimes I'm a little stern, but it's all in love. And that's basically what the basis of my job is. And I'm always available to all of my clients, day or night, family, friends. I'm just like, I'm the most compassionate home realtor. That's what's on my business card, the compassionate realtor, because I do understand when people are in certain life issues, like having poor credit but wanting to move further. I totally get it. I'm not the type of person that will, when I get your information, I will talk about it. I will share your personal information with others. That's just not how I work. I'm very professional. And whatever I don't know, I will get the answer. That's how I operate. And that's basically it.
Awesome. Awesome. Well, I appreciate that. I have a question for you. Um, what you're a realtor.
Yep.
So what is your jurisdiction? Where are you able to assist people with homes?
The state of New York.
The state of New York. Okay, all
State
of
of New
them.
York.
All of
My
them.
coverage area used to be the Bronx, some parts of Brooklyn, and Upper Rockland. But because the realtor boards merged, basically, that gives me a larger scope to look for houses like in Long Island,
Perfect.
And parts of Manhattan, because there's certain realtor boards that cover certain boroughs, and if you kind of tread on their territory, they get kind of feisty with you. But because we've teamed up with the Long Island board, that kind of gives the customers and clients who live in that area a bigger scope to look for houses,
Awesome.
Yeah.
Sounds like a plan.
Yeah.
That's great. Does anyone have any other questions in regards to home buying? Any questions in regards to credit? I know I had someone, was he? We had someone who actually was gifted some money and was able to purchase a home. So it's a thing. It happens. But again, even with that, we want to make sure that your credit and everything still is lined up before you start that process. And then, as Ms. Walker stated, that she's the last resort. So does anyone have any more questions?
I do.
Good morning, family. Oh,
Okay, good. Oh wait.
no. After you.
Okay. Real quick. So say for instance, a married couple wants to purchase a house and one has like 700 credit and the other one has 600. Like whose credit do they look at and how does the bad credit score affect their ability to purchase the home?
Miranda, that's a good question. Now,
It is.
do they merge or do they use the one with the higher credit score as the title owner?
I would say use the one with the higher credit score.
Mm-hmm.
That would be my advice. Yeah.
So they have the ability to pick and choose which one?
Say that again, Jennifer.
All right, go ahead, Ms. Jennifer.
I said they have the ability to choose which credit score they can use, although the couple is married.
I'm gonna say yes.
Yes, you can.
The reason why is because you just choose whoever's gonna be the title holder.
That's
So
right.
whoever's gonna be the title holder for the home, that's the name that the home could be in. Now, my question is this, Ms. Walker, can we add people to the title at a later date?
That I'm not sure of, but I can definitely find out.
Okay.
I could definitely find out. So Jennifer, if that's a particular thing that you're looking to do, I could definitely find out and get back to you.
Oh,
Okay.
I want to share this. So we have Jamal. Jamal, he's actually in finance. He states that when you apply as joint, the bank is going to use the average of the both, and that might bite you. So you got somebody that has a 700 credit score, and then someone has slightly lower. I wouldn't
bring
put
it
those
down.
two together because if you take the average is going to be a little bit lower. It'll be higher than a 6, but it'll be also lower than that 7. So, like I said, I would just use the one. I mean, the money's going to be the same. You guys going to be sharing the same money. It's the same household, but I would use the one with the better credit score in this regard.
Right. That's a good question.
Carl?
I think Carl had a question.
Yes. Hi. Hello, everybody. First of all, sorry about the baby noise in the background.
It's okay.
But my question is, if you're married, is it okay? So if you're married and one of the spouses has a higher and a better, in this case, credit score, are they able to purchase the house under their name, or when you're purchasing a house, it has to be both spouses have to be, I guess, on the title, or how does that work?
Well, again, I think we established that the one with the higher and better credit would be the one that would go on the title. And then anything else, like I believe the taxes and anything, is that so, Mr. Ford? The other spouse can be utilized for that other option.
All right. Okay. I think someone would like to answer. Uh,
Okay.
Jamal, you want? Yeah, by all means. I'm not certain where you are.
Is he on
Yes,
mute?
hi guys. Yeah,
Okay.
sorry, I'm at work. I've been listening in. I've been in and out of service because I work in the subway, but I wanted to step outside because based on experience, my wife and I we're in the closing process of buying our own house, and just to answer, I think the lady had a question about co-signing for a house and the credit scores that they use. Based on our experience, they use the person with the lowest credit score, and we had to, and because we knew that, we had to get my wife's score at 720 to get the approved rate that we wanted to get. My score was 760. My wife's score was low before, but she got it to exactly 720, so we was able to qualify for a 3.5% interest rate.
Good.
The reason why we had to use her as a co-signer because one of the things they looked at to qualify you is your income
Hmm.
and your debt to income ratio. So I needed my wife's income to help me qualify, to help us qualify to get the
That's
house.
good.
Okay.
That's
So
good.
the income piece. Yeah, yeah, yeah.
Right. So there's three things they look at. They look at the income, the money you're putting down, and your credit score. Those
Hmm.
are the three factors that they look at. So we had the down payment. We were blessed with the down payment money from my father passing away. We got a death benefit. So we had the income. We had the credit score. We got her credit score to 720, and mine is at 760. And what was the third thing? Income.
Income.
Based on our jobs, how much we make. So they had to calculate our bills, and so we had to pay off a couple of credit cards just so we get that correct debt to income ratio.
Hmm.
So it shows the lender that we can afford the mortgage. Now we're buying a two-family house, so there's other ways that they can increase their debt to income ratio by counting part of the house as income
Right.
property if you're renting out part of the house, which we were doing
Good.
because we're buying a two-family house.
Good.
So they can go ahead and do that. But there's certain ways around doing that also, and we decided that by just paying off a couple of things, like a couple of the credit cards and a couple of the 401k loans, because even though 401k loan is not a credit card, it affects your debt to income ratio because it shows you how much money you're actually bringing in, because
Right.
that's something that's coming out of your check. So when you have things like loans that are coming out of your check and stuff like that, the banks want to see like exactly how much you're bringing home. So that's very important. So just getting that the correct debt to income ratio is very important. So by paying off again, by paying off a few credit cards and paying off my two 401k loans, we were able to get qualified for a 3.5% interest rate. And as my wife as a co-signer. So both our names will be on the title. I'm first, and then she's a co-borrower on the
Okay.
loan application.
Gotcha.
Good.
So that's how that goes. But they do use the person with the lowest credit score. So it's very vital for my wife's score to be at 720 or higher, because that's the cutoff for certain interest rates. Now, if we were both above, I think 780, then it's an even better bracket. You get an even lower interest rate.
Right.
Absolutely.
That's great.
Absolutely. Thank
Yeah,
you, Jamal. I know you're working. I really appreciate that information.
Yes, I appreciate it
yeah.
too.
Yeah. You know what? I just and this is, and please, Miranda, correct me from what I heard, and you might even want to correct me as well, Jamal. If you're doing a cosign, and the
Hmm.
reason why you would do a cosign is because one of the parties has the larger income.
Right.
They're bringing that in, and you need to utilize that income
Yes.
for the
Yes.
home.
Right.
That's where
Correct.
that credit needs to be where it needs to be. And that's what we were talking about, that 700 club. God bless
Yes.
you. Yeah, awesome. Very, very
Okay, good. So Jennifer got an answer question.
perfect.
Yes, and then he answered her question.
Thank you. Thank you.
Awesome.
So just to add one more thing to that part, because of the price of the home was the reason why I needed her income. Because previously last year we were trying to get a house, and this house was 300. I think it was around 325,000.
Okay.
Based on my income alone, I was able to qualify for that loan by myself. Now, the
Okay.
two-family house that we are purchasing now, this house costs almost $1 million, and based on my salary, it's not enough.
Gotcha.
So that's why I had to have her income
Yes.
added on, and it's very
Yes.
important for her to have a good credit score, because it's not good enough to just have her income. Her credit score needs to be good, because that dictates the interest rate. You'll get approved for the house with the income, but if
Hmm.
her credit was bad, you won't get the 3.5% interest rate. You would get something a little higher.
Right.
So, and even though it may just be a couple of points, it's very important, because you're talking about over the course of 30 years, and it makes a difference of sometimes $100,000 depending on the price of the house.
He's
That's
So,
spot
right.
on. Spot on.
That's right.
mhm.
Spot on. That's
So,
it. I mean,
That's a perfect example.
so knowing how much home you can afford is very important. If you're going into a house with a spouse, you need to combine your incomes, and then you have to divide that by all of your bills. You have to add up all your bills, and
mm,
there's a certain percentage ratio that it needs to fall in, and that lets you know how much house you can afford per month.
That's
That's
right.
how these mortgage companies calculate that, based on income. If you have alimonies, all that stuff, all those fine little details is very important. So
awesome.
glad I was
Awesome.
able to help, because I'm going through
Thank
that stuff
you.
right now.
Thank you. Thank you. Thank you so much. I mean, that really
Yes.
helps. Miss Miranda, could you explain the difference between a mortgage broker and a realtor, which you are? Because I just don't want people to think, well, why wouldn't a realtor have this information and this, that, and the other? So if you can kind of explain the difference between a broker and a realtor.
Well, the realtor handles the real estate aspect of the transaction. A mortgage broker deals with all of the things attached to the mortgage, and they would better know the banking rules and anything that you need to know in relation to money. So us as realtors don't have any say so over the mortgage transaction. We just receive whatever it is that the couple or individual is approved of, and then we receive that paperwork, and then we work from what the mortgage company or mortgage broker has allowed for that customer to receive. So the two has to work in partnership, but one doesn't overlap with the other.
Gotcha.
If that makes sense.
Gotcha. That definitely makes a lot of sense. I mean, this boils down to, credit. You got to get your credit right.
Yep.
And I also want to make just an observation as well. So
Mhm.
because of, you're gifted, with say monies from wherever, you can use a portion of that to pay down on
Yes.
whatever you owe, and by
Yes.
paying off that credit, that's going to improve your credit score.
Right.
For those that aren't able to do that, again, that's why there's companies like myself who are able to work on it on the back end, and as also give you that information. Because my thing is this: we don't want to just fry the fish. We don't want to just fix the credit. We want to show you how to do it,
How
so
to
that
do it.
one, you can break that habit, and that you won't go back into bad credit, or back into the situation that you came to us for first in the first place. So, we want to make sure that your credit is right. Some things to think about in regards to your income, your debt to income ratio, and then making sure that you're ready, really ready before you pull in the Mirandas.
Right. Awesome.
So does anyone have any more questions?
Hi, yes. I have a question from one of our Facebook viewers, and the question was, if you're about to get divorced, would it have any effect on your credit or buying a home? What are your suggestions?
Good question.
I'm not quite sure with divorces. I would say that they should consult with their attorneys, and then from that point on, because I guess if you're married, you'd have to try to figure out how to divvy up certain properties and assets, and it can get really jumbled. So my suggestion as a realtor would be to consult your attorney in matters of what to do next, what's the next step, how does it affect your credit, and then they can come and sign up and talk to the Ford agency, and you guys can help them get on track if their credit is not great. That would be my suggestion.
Right. I mean, one of the things I would do as an individual, I know where, those couples, whether you're married or not, or you're together, I would say you still have to look at it from an individual perspective. You want to make sure that your credit is in check and up to par. Credit is one of those things. It's almost like you giving yourself a healthy check every 6 months. Making sure that your credit is healthy, making sure that your finances are healthy, and it's something that you can do because it's yours. You want to make sure that whatever it is, whatever financial decisions that you're making are positively affecting your credit score. And because you can check your credit for free, you can actually see what's on your credit before you can start making any drastic moves. And I think that's what you should really start with first. Checking your credit, see what's on there. Mm-hmm. Try to understand, what it's saying on that credit report. And again, to boost the company, that's protection plan that we have, that credit protection plan. We have a service that's on there called Credit Builder. That Credit Builder literally shows you what's on your credit, how to read it, what's it saying in layman terms. There's videos, there's things that you can see so that you're an educated consumer. And that's what we want to make sure that you are. An educated consumer becomes a qualified buyer. All right. So, we hope that you aren't in a situation where you're neglecting anything that has to do with finances, because it's very important. And we don't want to, wait till the last minute where you're kind of like, okay, you're rushing to do things. This is something that if you plan it out, you can get your credit, up to par within 6 months to a year. It's very doable, but we just got to give some attention to it.
Right.
Any other questions?
Concerns, comments? Let's see.
Okay. Anyone here?
Can I make a comment?
Yes, please.
Sir, go ahead.
Sure. So, like you guys said, this is a good thing you guys are doing, educating us. It's very important to go into this thing educated and know exactly what they're doing. When my wife and I went into the realtor's office, we knew what debt to income ratio was, and because we need to be at, it made things a lot easier and smoother. So definitely, like you said, there's videos out there, and with your agency and with what you're doing today is helping people. And then even with my experience is helping people to understand what they need to have, because you don't want to, I won't say look foolish, but you don't want to look ignorant going into something and you don't know what your numbers are.
Absolutely.
So it's very important to have these numbers and to know what they mean, because the house that we were trying to buy, someone else was trying to buy it. They looked, the guy told us they looked silly because they didn't realize, like, there are other things besides the price of the house you have to account for closing costs. Closing costs 3 to 6% of the price of the house. So obviously, the higher the price of the house, the higher the closing costs.
Right.
And then you have fees. I have to pay an attorney fee of $1,400. To get an appraisal was another, I think, $600. To get the inspection done on the house was $1,200.
Right.
You have to have all these things.
Mm-hmm.
You have to account for all these things. So, it may sound discouraging, but you want to at least know the numbers, at least down to the dollar, how much you need to know roughly, so that when you go into this thing, you're prepared. Because God works in mysterious ways, but I'm glad that God has ordered our steps the way He did, because the house we were trying to buy the previous year, even though we tried to educate ourselves, we weren't ready. We didn't have the down payment money. We didn't have we had some of the down payment money, but we didn't have closing costs. We didn't account for all the fees that are attached outside of the closing costs. So these are things that people need to know before they get into getting a mortgage, all those fees.
Absolutely. Absolutely. Well, I appreciate you, Jamal, for that tidbit. I mean, that honestly, that's valuable. I should say invaluable information. So thank you for that. I really appreciate it. So, you know, Ms. Walker, do you have some information that we can post about you so that if anyone is looking for a home in the New York area, we can put your information so that they can contact you in that regard. And
Absolutely.
yeah, just if you can send that to me or plug it in there, we'll make sure that it is plugged into our Facebook group as well. Um, Perfect. All right, so it's Exit Realty All City. All right, I'm gonna say it again. So that's Exit Realty All City. All right, and the real estate agent is Miranda Walker. All right, and her phone number is 718-503-1948. Right, and I'm going to make sure that that's being posted on my social media and as well, so that those that are looking for a home, they can contact you. All right, and then again, those who are looking for credit repair, they're looking for not just a credit repair company, but a company who's going to walk them through the process, is going to help them and educate them on that proving process. I'm going to put out information up one more time. All right. So you guys have it. All right. It is the M&L agency. Again, we deal with credit repair. We deal with life insurance, mortgage protection coverage, final expense. Our phone number is 347-990-2087. Our website is themnlagency.com. And we can be reached pretty much at any time. So we want to make sure that you have the information accordingly, so that when you're ready to make that decision, you don't look foolish. All right. Thank you all right, for attending. And if you guys don't have any more questions, I don't know if you want to have any last words, Miranda.
No, I just once again want to thank everyone for taking the time out of their busy schedules to attend this session. I hope it's been informative. I hope it's given you a little bit more power and a drive to fix your credit if that's what you need, and to give you a little bump up if you didn't have the courage to talk to a realtor in terms of what your options are. And I'm looking forward to doing many other collaborative sessions with the Ford M&L agency in the future. Thank you, guys.